What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is February 1st of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about why I believe both the bulls and the bears are wrong when it comes to Bitcoin's price action going into this week during the FOMC meeting. This is a huge event, and because of that, it's got traders on both sides of the equation thinking that we're going to either go supersonic to the upside when it comes to the bulls or collapse into oblivion when it comes to the perspective of the bears. But in reality, I think that both traders are going to get caught up in what we call the liquidity trap. I'm going to spend some time to talk about it in today's video. If you guys happen to enjoy this video, drop a like. It's one of the greatest ways you guys can support the channel. Helps me do what I do here full time. And let's go ahead and kick off the rambling. Okay, so I want to go ahead and do some general analysis here on Bitcoin as well as equities. Then we're going to kind of lead into this point of why I think both traders are really going to get trapped here. Bitcoin's definitely made a lot of progress since the relative lows in this bear market back on November 21st, 2022, when the FTX capitulation was in full swing. And since then, after this 58% move or 55% move in price, really since back here in the later part of January, for the last 10 days, we have been pushing sideways, waiting for some kind of catalyst to lead us in either direction, resting right below the 200-week moving average and well above the 200-day. This has led a lot of people, as this is the first time we've been able to get back above that 200-day since as far back as April of 2022, to believe that we are in the next bull market, that there is no debate that this is the start of the next uptrend. Whereas you have other participants as well who, for example, like us, have leaned more on the bearish side, saying that this is likely another relief rally. And this will kind of lead into our conversation today, because again, I want to go ahead and emphasize something here. I don't think the FOMC meeting is going to lead Bitcoin to dump. I don't think that we are going to see some major flash sale, even though I generally believe that Bitcoin is going to move lower in the long term. All right, that's an opinion we can have here as a bear here on the channel. In fact, I think the counter opposite could play out. I think we'll hold out sideways through this meeting. If anything, over the next couple days after the meeting, we could still continue to move higher. And why is that? Well, let's just go ahead and take a look at it here. If we take a look at the market order flow through our partner Bookmap, while we are seeing generally sideways price action, right, we've been having a generally negative outflow here, both in the spot market for multi-book, which is taking a look across a variety of exchanges, and also in the futures contracts. But I gotta be honest with you guys, even though it's definitely negative, we are not seeing anything too crazy just yet. And as we've talked about before, 1 week of positive market order flow pressure is not enough for us to be absolutely concerned that, oh my gosh, the bull market is back. Same goes here when it comes to negative market order flow. We've had multiple weeks of green market order flow when it comes to the futures contracts, and when it comes to the spot market, generally relatively neutral or maybe slightly positive numbers, especially on that broader uptrend. So again, while this is a very important tool for us to watch, and it's something we always review at least once a week here on the channel to try to get an understanding of the pressure over the last, say, week in regards to price action, so far, even though it's negative, it's not enough to scare us yet. It's not enough to spook us. This could change on a dime here. We could continue to see us revert back to the general trend over the past month, which has been moving to the upside. Okay? So again, if you guys are interested, I recommend you guys check out Bookmap down below in the description, and one of our partner tools on the channel. It's a really good way to look beyond just price. It's one of the only major trading tools I use outside of TradingView when it comes to trading and swing trading on Bitcoin. Okay, so market order flow is definitely not really the big concerning factor here. But let's go ahead and take a look at equities as well, right? When we take a look at equity charts, right, the NASDAQ is back up against the 200-day moving average. This is the first time we've been in this pocket since as far back as August, when the Fed was previously presenting and put down the hammer on the markets, and also back in March of 2022. As always, this is a point of contestment. It's an area where people are starting to learn time and time again that usually prices get knocked down. But that's something, again, I want to lean into as we go throughout our conversation here. A lot of bears are already building their puts, are already starting to short, are already building their positions, putting chips on the table, betting that prices are done rising, that they can't go any further. And I got to tell you guys, that kind of bear euphoria, that kind of dependency on the past is likely not going to pay off and will lead you losing money or taking too much risk. I'll talk about why that is in a bit. ES here, S&P 500 E-mini futures, coming up here yet again to a level they were at back in December or back in September of 2022. Albeit still definitely lower than where we were back in August, we've been able to potentially build short-term support here on the 200-day and the previous line resistance. This again is leaning in to why some people are feeling optimistic here. These are definitely the signs that would be the first initial steps to starting another bull market. But again, as we talk about here, we're going to try to keep it a bit moderate. I think that what's going to happen is you're going to knock out both sides of the trade here, okay? And this has to do with Papa Jerome Powell, okay? Now, what we wrote about in this month's newsletter, I think really hits home on something that has been definitive of this bear market. And that is that when the emotional crowd really starts leaning in against the Federal Reserve, this is a moment for the Fed to strike, to absorb a lot of this excess liquidity in the system that's causing inflation. And you guys know, if you've watched the last two videos, we've been talking about this liquidity trap, quote unquote, and how we need to be made aware of it. Now, if you guys have been looking through the headlines, for the FOMC meeting, you've got everyone and their grandma having a sharp opinion as to whether or not after Jerome Powell speaks, equity prices are going to dump or they are going to ascend and completely rally beyond belief. And again, I want to go ahead and make something very clear that I don't think many content creators out there are telling you guys, which is that it doesn't have to do either of those things. It can go sideways. But on top of that as well, it can go sideways and then make some move afterwards. And it maybe doesn't have to be so significant towards either direction. It could be a slow uptick or a slow downward move. And why is this? Well, it's because we are already pricing in a very, 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 very high probability, over 90, I think 95, 98%, that the Federal Reserve is only going to increase by 25 basis points. I would in fact make the argument that since back here in late January, that the markets have been generally confident on what the Fed is pricing in, hence why we've started to see some sideways move in Bitcoin, hence why we came up here into the 200-day around the same period of time, and have continued a general upward move in equities and crypto. All right? I think the markets are starting to feel like the Fed has gotten control on things. And this leads me more into my topic, which is focusing on the longer term ramifications of what the Fed is doing right now. Now, I have to be honest with you all, I have a relatively neutral opinion on how the Fed is approaching things. I don't per se mind the Fed taking a 25 basis point hike. They could continue with 25 basis points time and time again with each FOMC meeting and probably start to cool inflation. They could flatline for a while, see some signs that inflation is coming back, and then start to cater more with higher interest rate hikes. They could engage more in quantitative tightening. There's tons of different approaches to this, but the big thing I want you guys to know about is that inflation is incredibly sticky, and it will come back faster than you may think. A lot of people, I think, are going to get caught in what we've defined as the liquidity trap. It will be an upward continued move, perhaps not today after the FOMC meeting, but over the next coming weeks into the later part of Q1, where a lot of investors are going to get trapped. Most people are going to, in the case of the bears, get squeezed out of their short positions. They're going to dump their puts. And in fact, they likely will join in with the broader retail crowd who is getting overtly long right now, who are getting yet again euphoric about the price action that's going on right now. As you guys know, we haven't been short in the market. We've been sitting on the sidelines in cash. And because of that, we have the discipline to be able to stomach these short-term rallies in the market. Right, we've seen these before. In fact, we've seen much bigger moves for, say, the NASDAQ, for the S&P 500, and even for the Dow Jones or Russell 2000. We've been here before. It's history, just repeating itself or rhyming to a degree with what it's done in the past. It's the same exact principles that will either lead you making solid returns or getting chopped up. And I got to tell you guys, the big principle here that I'm focusing on is making sure that I wait for those exacerbated periods when everyone is convinced that things are going good, that we are in the next bull market, and trading alongside what we've heard from the Fed time and time again, that inflation, getting inflation down to 2% is the number one target. I don't care what Jerome Powell does in this FOMC meeting. Heck, I wouldn't even care if he did a 0 basis point increase or a 50 basis point increase, because I know that the Federal Reserve's mandate is to get inflation back down. As we talked about in the previous video, there are a lot of people saying, oh, the Fed is changing its metrics on how it calculates inflation. It's going to do X, Y, and Z, and therefore it can ease. Or the Federal Reserve needs to crush things right away. I think both of those narratives might be very, very short-sighted. And in fact, we just need to understand that it's going to take time to get down to 2% inflation, and that the sooner the Federal Reserve addresses it, the better. And the Fed is trying to do it in a way where hopefully nothing too severe breaks, that investor sentiment doesn't get crushed, but at the same time isn't going to allow for a secondary wave of inflation. And to get down to that 2% annual target is not only going to take a couple months, it may take up to an entire year if we start to get some positive months of inflation. And we are already starting to see commodity prices, not just natural gas and oil, right? But we're seeing industrial commodities, food-based commodities, starting to move back up. You guys can take a look across the board. It's something, again, we hit on in this month's newsletter. I highly recommend, if you guys have been kind of on the edge of your seat, thinking about checking out the Dash report, this month we've got a ton of plays at elevated prices from where we are right now that we are looking to short. We're looking potentially buy puts on and make a really big generational trade on. This is, again, one of those time periods where if you can maintain that patience, there can be a lot of great opportunity within the market. And that's the great thing about the Dash report. It's not just a newsletter each month that we put out where you guys are able to get my thoughts on crypto, stocks, commodities, and Forex, so you can find all types of different trading opportunities, but you also get an audio read along where I kind of dive through different parts of the newsletter. You guys get to join the discussion group. You join our trade alerts group where you guys can know when I'm making trades in the market. And on top of that, you guys will get exclusive market updates that we send out only to Dash Report members. You'll know when we really are sinking in to those trade positions. So where I'm putting my money to my mouth, I'm making those big moves and really trying to take advantage of major swings in the market. If you guys are interested in checking out the Dash Report, you can check it out down below in the description, and you can get a really solid discount, over 20% off, if you guys sign up for an annual subscription. It's a great way to support the channel if you've been thinking about potentially supporting us on Patreon. This is, again, one of those great ways where you guys can get something out of it, and it's a great way where it allows me to be able to do YouTube full-time, builds a consistent line of revenue and stuff during all the upswings and stuff here on the channel. So if you guys are interested, feel free to check that out. But even if you can't, right, I want you guys to be prepared here for what's to come, because I think, again, as we're keeping it open here in the channel here, right, I don't want to paywall everything. I want to make it very clear that I think this uptrend we're seeing, this euphoria, could very well continue because the Fed is already the market's already pricing in the Fed's move to 25 basis points. That being said, I really want to make it clear that while more people are going to get confident, while prices will continue to move higher, I think it is a trap, and we are going to start to roll over yet again, deviate back below those 200-day moving averages that we're now trying to treat as support, and that is when a lot of the pain is going to come. I want to pull back full circle to crypto here because, again, speaking about the underlying signs that showcase that we don't have the real sustained euphoria and optimism to be able to maintain a bull market, look no further than the ETH to BTC ratio, which yet again, week by week by week since back in January, while Bitcoin has been ticking higher, the ETH to BTC ratio is showcasing lackluster momentum. And this is not a good sign to see. We should be seeing more risk on, more confident assets, especially those that are driven by the narratives that could potentially drive crypto up long term, such as the move to proof of stake and EIP 1559. These deflationary things are supposed to help Ethereum's price. So what's going on here? Well, as we've talked about, while EIP 1559, while the move to proof of stake, all these things are good, they don't answer a fundamental question. Will there be more sellers than there will be buyers? Put aside the monetary policy. We got to ask that question first. And folks, there is a big dynamic that people are not thinking about now. Corpy on Twitter put out a really good tweet here where he talked about the upcoming ETH withdrawals that are going to come through the Shanghai update that will allow individuals to withdraw the proof of stake ETH that has been locked up potentially as far back as 2020. It is estimated that up to potentially 1 million ETH could be withdrawn. To put that in perspective, that's over $1.5 billion of potential withdrawal and therefore potential sell side pressure in ETH's price. If you're withdrawing it from proof of stake, let's just say you're likely going to be selling it, right? There's not much reason to withdraw. You'd be getting the proof of stake rewards. Why not stick in it, right? So if people are going to be withdrawing this amount of ETH, and I highly recommend you guys check out the thread, although it again is an estimate here, right? Things could vary. We need to understand that there is going to be a rush to withdraw because not all that ETH can come out all at once. It's a certain threshold where block by block or epoch by epoch, people are able to withdraw that ETH. And that is just going to continue day by day, actually, to cause more excess sell side pressure. And it's going to continue to weigh down price from being able to make higher lows and higher highs. That is why, as we approach this update in March, in Q1, the month where we think asset prices are going to be elevated and therefore start to move lower, this is what we need to watch out for. This is why ETH has not been able to make higher highs against Bitcoin since as far back as December of 2021. This staked ETH is a big potential weight on price. And on top of that as well, we've got to take a look here at our data science models through CryptoQuant, another one of our partner tools here on the channel, and one of the best data science platforms I've found out there, between the pro charts that are made by community members, as well as the dashboard tools where you can really get different insights from different participants. And as I've mentioned before here on the channel, guys, this data dashboard or the CryptoQuant data analytics board is free for all of you guys to access. You can check it out, the link down below in the description. Drop a like, drop a star if you guys want to follow it. It's free for you guys to access, so why not? And I think one of the big things that, again, I really want to focus on is not getting deceived by this kind of over move here on a lot of the indicators like the net unrealized profit or loss. Again, I know a lot of people are immediately looking at this and thinking, oh my gosh, this is November of 2015. This is April of 2019. We are out of the woods and we are ready to start moving higher. Folks, this is a completely different bear market than what we've seen in the past. As we've talked about, right? This kind of capitulation just coming down into this blue range like we did back in 2019, if this is what people think is the bottom here for Bitcoin, right, that we don't have a chance of moving lower, folks, you gotta be able to prepare for much, much worse. If inflation comes roaring back, if the Fed has to continue tightening, this is going to contract liquidity even more than the Fed is already doing. Not to mention all of the destruction, the lack of trust in this space, right? Again, I would say look towards 2011, look towards 2015, a period where there was major restructuring in crypto. And you can see when you zoom out here, we've had moves like this before. We've had these kind of upswings, right? Right before things got worse. It's not enough for us to get bullish. It's not enough for us to get euphoric yet. We haven't even really had a true consolidation phase. And on top of that, when we come back here to the dashboard, take a look at that supply and profit. This is, again, one of the big indicators here that I think is important to watch. It's one of our custom indicators, taking a look at that SMA, right? Again, if we try to get in the most recent move here, which is definitely jolted higher, we've had these moves along the way before we move down into the proper consolidation range, around less than 50% of the market or more, around 45%, having positions in profit when it comes to the UXTO on chain. I just want you guys to make sure that you can preserve your capital, preserve your wealth. If you've made a lot of money over the last decade, I can tell you guys, it's not a matter of missing further opportunities to make money, trying to keep up with inflation that's going to cripple you. The thing that's going to cripple you is losing all of that money, making overtly emotional trades, chasing each and every rally, and doing exactly what the exchanges, what the insiders, and most importantly, ironically enough, what the Fed wants you to do. They want you to get caught in a liquidity trap. They want you to buy overvalued positions, face losses, revenge trade, and lose that excess money so they can meet their inflation targets. It's as simple as that. I know a lot of people think that that's silly, that the Federal Reserve would care about these things. But once you start to understand that concept, and we dive into it quite deeply in this month's newsletter, you start to get the bigger picture. And it all starts to become very, very clear. Anyways, guys, that's it for today's video. I rambled on a good amount here. If you liked this video, if you like some of the information we shared, consider dropping a like. It is one of the best ways to support the channel. If you guys can't sub to the newsletter, I totally understand. It's difficult times, but if you guys can at least consider dropping a like, it's a great way to get the word out there. It helps us in the YouTube algorithm. And hopefully we can get this message out to more people. I really don't want people trading too excessively on this Fed news because I feel you get caught up in the chop, you get caught up in the volatility, and you lose focus on the bigger picture, which is that while we may continue to have some euphoria can stretch out much longer than anticipated. Eventually that euphoria comes to a screeching halt when reality kicks back in. That's it for today's video, everyone. Take care, and I'll see you all in the next one. Take care, everyone.